Hello everyone, and welcome to this case study presentation on the Public Company Accounting Oversight Board, or PCAOB as it's referred to in the tax world, according to my CPA parents. In today's presentation, we'll explore PCAOB's legal foundations, history, key organizational structure, and the challenges it faces, and its profound impact on corporate governance and investor protection. A quick introduction to PCAOB. It was established by the Sarbanes-Oxley Act of 2002 in response to major corporate scandals to protect investors and ensure accurate financial reporting. Established in 2002, PCAOB is a unique regulatory body that oversees the audits of public companies to protect investors and the public interests. The Public Company Accounting Oversight Board has a unique legal structure as a non-profit corporation established by the Sarbanes-Oxley Act of 2002. Though it operates independently, PCAOB is under the oversight of the United States Securities and Exchange Commission, the SEC, which appoints its board members and reviews its rules and standards. The PCAOB was created in response to the major corporate scandals of the early 2000s, particularly Enron and WorldCom. These scandals revealed significant gaps in the auditing and reporting practices of public companies. To restore investor confidence, Congress passed the Sarbanes-Oxley Act of 2002, which mandated the creation of the PCAOB, and under the SOX Act, the PCAOB was established as a non-profit corporation with the authority to oversee the audits of public companies, as well as broker deals, ensuring the accuracy and reliability of financial reporting. The PCAOB operates as a quasi-public entity governed by a 5-member board appointed by the SEC. While the PCAOB functions independently, its legal structure is closely tied to federal oversight, and it is subject to significant regulatory control from the SEC. The PCAOB's authority to set auditing standards, inspect audit firms, and impose sanctions gives it broad power over the financial reporting process in the United States. One of the most significant legal challenges faced by the PCAOB came in the Free Enterprise Fund v. PCAOB case in 2010. The United States Supreme Court addressed the constitutionality of the PCAOB's structure, particularly the fact that its board members could only be removed for cause. The court ruled that this structure violated the separation of powers, leading to changes in the oversight and appointment process of the PCAOB board members. This case underscored the tension between maintaining PCAOB's independence and ensuring accountability within the executive branch. Recently, the PCAOB has ramped up its enforcement actions, particularly against audit firms for failures in auditing public companies. In 2023, the PCAOB imposed significant penalties on several audit firms for failing to meet audit standards. These actions highlight the ongoing challenges of maintaining high audit quality in a rapidly changing financial environment. As firms struggle with issues like digital transformation, international compliance, and the evolving nature of financial reporting. On November 15, 2023, the PCAOB issued sweep sanctions against multiple firms for failing to comply with communication requirements with audit committees. These firms' sanctions included Cherry Bekaert at $35,000 penalty and Deloitte in Luxembourg for $50,000 penalty as well. These firms were found to not have made certain required communications about the participation of other firms and individuals in audits. Since its creation, PCAOB has had a profound impact on investor confidence in the United States capital markets. By enforcing strict audit standards and holding firms accountable, PCAOB plays a crucial role in preventing corporate fraud, promoting transparency, and ensuring that public companies provide reliable financial information. However, there are ongoing debates about the PCAOB's reach and whether its inspections and enforcement efforts are sufficient to address the complexity of today's financial markets. In conclusion, the PCAOB is a vital institution in the landscape of business regulation, balancing its role between government oversight and private sector accountability. The organization's legal structure, regulatory authority, and the challenges it faces offer critical insights into the broader dynamics of corporate governance and the protection of public investors. As we look to the future, the PCAOB's ability to adapt to new financial risks will continue to be a focal point of discussion in business law. And as we wrap up, I want to leave you with this to consider. With the growing complexity of financial markets and the rise of global corporations, how should the PCAOB evolve to remain effective in protecting investors and maintaining the integrity of financial reporting?